Welcome to video 1 of part 1 of the EA Tax Training free EA exam prep course for 2026. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Before we get started, I would like to point out that you can get a free copy of the slides for this video and all the videos in this course. On YouTube, in the description below each video, is a link where you can have PDFs of the slides for all of the videos emailed to you. When looking at the description, you may have to click on the word more to see the full description with the link. With that out of the way, let's look at an overview of part 1. Part 1 of the EA exam is all about individual taxation. We've got 7 videos for you in part 1. This first video you're watching now we call Overview and Getting Started. In video 2, we'll talk about income. In video 3, we'll talk about a special kind of income called capital gains. Then in video 4, we'll cover adjustments and deductions from income. In video 5, we'll discuss calculating the tax and tax credits. Video 6 is all about retirement accounts and Social Security. And finally, video 7 will cover specialized returns and topics. A couple of important points about the 2026 exam and this course. The 2026 EA exam, officially known as the Special Enrollment Examination, or SEE, is based on the 2025 tax law. Specifically, it is based on the law as of December 31st, 2025. So that is what we will be covering in this course. And the 2026 exam will be given starting May 1st, 2026 through February 28th of 2027. Even those exams given in January and February of 2027 are still technically the 2026 exam and are still based on the 2025 tax law. Also, as you may know, there was a big tax law passed in 2025, sometimes called the One Big Beautiful Bill Act, or OBBBA. Some of the provisions in that law are effective for 2025 and so will be reflected in this course. But many of the provisions of the OBBBA are not effective until 2026 or even later. So those will not be tested on the 2026 exam and so are generally not part of this course, though I may mention them from time to time. If you are interested in all of the provisions of the OBBBA, I did a comprehensive video on it, which you can find on this YouTube channel. It's more than 4 hours long. But for now, let's concentrate on 2025, which is what you need for the exam. I look forward to guiding you through all of these topics. So without further ado, let's jump right into video 1, Overview and Getting Started. In this video, we are going to do an overview of the individual tax return and individual tax system in general, and we'll talk about what you need to do in getting started to prepare a tax return for a client. Specifically, what we'll cover in this particular video is an overview of Forms 1040 and 1040-SR. Then we'll talk about the sources of information you need for preparing a tax return. Then we'll talk about the filing requirements and due dates, who even needs to file a 1040 and when do they need to file it. Then we will go into detail about the top section of the tax return, covering the Social Security number, tax residency, filing status, dependents, and checkboxes. First, near the beginning of each video in this course will be a slide like this one with free resources available from irs.gov that are related to the topics being discussed in that video. You can go to irs.gov and download PDFs of these documents for free. And a pro tip about the EA exam, it is based primarily on IRS publications and form instructions. So that is mostly what you will see here. Now, you don't need to necessarily get every one of these. Your time is limited. I understand that. You cannot review everything possible. So what I have done is put the most important of these publications and form instructions in bold. So for this first video, you'll see 3 of them in bold. First is publication 17 called Your Federal Income Tax. This is, in my opinion, the textbook for part 1 of the EA exam, not just for this first video, but for all of part 1. And if publication 17 is the textbook for part 1, then Form 1040 and its instructions is the workbook for part 1. So you will definitely want to get both of those. And then the third one you can see there in bold is the Form 1040 NR. This is the tax return that non-resident aliens need to prepare. So you will want to look at that and its instructions. The rest of these are also great. They cover the specific topics that you see. So if you are more interested in those topics or you need more work or more information about those topics, you can check those out as well. So now let's do an overview of Forms 1040 and 1040 SR. And we'll start, before looking at the forms themselves, with looking at the overall flow of the income tax return. This is kind of the big picture look at what we are trying to do. So we're going to start with our gross income. And the idea is to figure out, do we owe the IRS money or do we get a refund from the IRS? But in order to get there, we have all of these steps that we need to go through. So again, we start with what's called our gross income, so all of our income. Then we subtract something called adjustments to income. That leaves us with a very important number called adjusted gross income, AGI. AGI is a very important checkpoint on our way to figuring out whether we have an amount due or a refund. Many provisions of the tax law refer back to adjusted gross income, so you'll want to take special note of that. Once we have AGI, then we are going to subtract our deductions. That will leave us with taxable income. Once we have taxable income, we can then compute our income tax. We do that by applying either tax tables or tax rate schedules. That then gives us our income tax, but we're not finished yet. Some taxpayers will then have tax credits that they can use to reduce their income tax, and some taxpayers will have other taxes other than income tax that they need to pay. So we need to add those back to their income tax. Once we subtract the credits and add the other taxes, that leaves us with our total tax. Once we have our total tax, we will then subtract our payments. That could be something as simple as the withholding that we have from having a job, or it could be estimated payments that have been made or other types of payments. We will also subtract what are called refundable credits. Those are treated as if they were payments. And finally, that will leave us then with our amount due to the IRS or our overpayment or refund from the IRS. So now let's look at the forms themselves. This is page 1 of the Form 1040. So at the top of the form, you're going to see some basic information such as your name, social security number, and address. You're also going to choose your filing status, which we will talk about more. There are some check boxes that need to be done. And then finally, some information about dependents. We are going to get into detail about this top section of the return in this video. Then we're going to move down and we're going to talk about income. Remember our flow chart, we started with gross income. So we're going to put all of our various types of income. And then, as you'll recall, we had adjustments. So we've got adjustments to income. Those will actually come from a different schedule, Schedule 1, but we'll put the total here. That will leave us with our adjusted gross income, or AGI. So the bottom of the first page of the 1040 is that adjusted gross income. Then we will move on to page 2. And at the top of page 2, we will again see our adjusted gross income. We're going to put that again here as a reference. Then we've got a few more check boxes. Then we're going to get into the various types of deductions that we have. That is going to leave us with our taxable income here on line 15. Then we will show our actual tax here on line 16. Then remember, we have some credits. So those credits will be listed here, and we could have other taxes, which will also be listed here. That will then leave us with our total tax. Then we will show our payments and our refundable credits, which will leave us with our total payments, which will then finally tell us, did we have an overpayment for which we would need a refund, or do we have an amount due? If you have an overpayment, you can see here, you can actually put your routing number and your bank account number so that refund can be deposited directly into your account. You can also have the payment taken directly from your account if you would like to do that. Then we get down to this third-party designee section. So what this does is this allows you as the preparer to put your name and phone number in here. And as long as the taxpayer agrees, then the IRS knows that they can discuss this tax return with you rather than having to talk to the taxpayer themselves. So if the IRS has a question, or if you want to ask a question about the return, you can call the IRS. They will know that this box has been checked and they can talk to you. We will talk much more about the details of that in part 3 of this course. Then at the bottom of page 2, we have the signature blocks. So this is where the taxpayer is going to sign and where you as the tax preparer are going to sign. And notice there is this perjury statement. So this says, under penalties of perjury, I declare that I have examined this and that everything is true. So both the taxpayer and you are signing this return under penalties of perjury. So you want to make sure that to the best of your knowledge, this tax return is correct. So we will talk much more about that later in this video and in this course. So that is the basic 1040. Of course, there can be many other schedules and forms that are attached to the 1040, but this is the basic 1040 itself. Next is the 1040 SR. SR stands for senior. This is a return that was developed specifically for taxpayers who are age 65 or older. What you will notice is it looks very much like the regular 1040, and that's because it is doing the exact same thing as the regular 1040. So it is starting with the same information. The only difference between the 1040 and the 1040 SR is the font size. So people who are age 65 or older appreciate having a larger font so that they can see the return better. So all they have done is made that font size larger, so they have made it easier to see. Everything else is the same. You're putting all of the same information. You're putting all of the same income amounts, all the same deductions. The standard deduction amount is exactly the same as if you were using the 1040. The income tax owed is exactly the same as if you were using the 1040. The amount due or the refund, exactly the same. Nothing substantive is different. It is just a different font size. Because the font is larger, instead of being able to fit it all on 2 pages, it takes 3 pages to put the same information. And then what they have done is they have added a 4th page, which is really just a reference chart for the taxpayer showing the standard deduction under different circumstances so that they don't have to go and look that up. Now, the 1040 SR is most relevant for those taxpayers who are filing on paper rather than filing electronically. And the vast majority of tax returns these days are filed electronically. It's approaching 90%, I believe, of returns are filed electronically. However, I think it's fair to assume that a large portion of the returns that are filed on paper are filed by people who are age 65 or older, because that's the way they've always filed. That's what they are used to doing. And so many of those people will still file their returns on paper. If you are doing the return, of course, you are going to be filing it electronically. So it's not absolutely necessary that you use the Form 1040-SR. You can use it for those taxpayers who are age 65 or older, but you do not have to. It might be nice to do. You are going to be giving your clients a copy of their tax return. Those who are age 65 or older might appreciate having their copy with the larger font, but you do not have to do that. This is voluntary, so it is up to you and your client whether or not you use the Form 1040-SR. As I go through the course and I talk about filing your return or filing your 1040, I am not going to be mentioning the 1040-SR, but just know it doesn't matter whether it's the 1040 or the 1040-SR, it is going to get you to the same result. So now let's move on to your sources of information. If you're going to prepare a tax return, obviously you need to get certain information in order to do that. So where do you get that information and what kinds of things are you looking for? The very best place to start in preparing this year's tax return is to get a copy of last year's tax return. So if you prepared last year's tax return, then you will have it. You will want to review that before you do this year's tax return. If you did not prepare it, then you want to ask the taxpayer to provide a copy for you. What it will do is a few things. First of all, it will give you basic taxpayer information, names, address, social security number, etc. Now, you always want to verify those things. Things can change, especially addresses, but it's a great place to start. It's also going to give you a good clue as what to look for this year. Taxpayers tend to have the same kinds of things from year to year. W-2s, 1099s, K-1s. These are all forms that you're going to become familiar with throughout this course. But if they had them last year, then there's a pretty good chance that they're going to have them this year. There can also be carryovers, things that flow over from one year to the next. Things like net operating losses, capital loss carryovers, other things like depreciation that they may have. You're going to see that from year to year. So it's good to have at least 1 year's prior tax return so you can see those types of items. And then also, once you finish the tax return, it's good to compare it to last year. It's good for both you as the preparer as well as for the taxpayer, because the taxpayer can see, okay, I had this much income last year, this much this year, etc. And you can also see that, and it can help you to find mistakes. If you see a big discrepancy between years, you'll want to look and see, well, why was there that discrepancy? Did you miss something, or was it just a big change? But it'll give you kind of a clue to go back and check things to make sure that you've got everything that you need in the return. Now, what if you cannot get last year's tax return? Does that mean you can't do their return? Well, no, it doesn't mean that. It's very helpful to have. You want to have it. If you cannot get a copy, that's okay. We'll actually talk in part 3 about ways that you can get a copy of the return if the taxpayer doesn't have it. But even if you don't do that, it is still, of course, possible to prepare this year's return without having it. It's just very helpful to have that. Now, what if when you are looking at last year's tax return, you spot an error? Maybe the previous preparer made an error. Maybe you made an error. I hate to say it, but it does happen. We're all human. You are going to make mistakes sometimes. Maybe the taxpayer did the return themselves and made an error, but doesn't matter. Either way, if you spot an error on last year's tax return, you need to tell the client about it and explain the consequences of that error. But you are not required to fix it. So, what you want to do is tell the taxpayer, hey, look, I was looking at last year's return and there is an error here. And here is the result of that error. Now, it can go either way, of course. It could result in the taxpayer owing more money, or it could result in them getting a refund. So you want to explain to them, let's say they would owe money. Then you will say, hey, look, you have this error. The result of the error is that you should have paid in more money than you did. So what we can do is we can amend last year's tax return. You will have a balance due, and the IRS is going to charge interest and penalties on the amount that is due. Or let's say there would be a refund. You can say, look, there was an error. You should have gotten more money back than you did, or paid less money in than you paid in. If you amend the return, then you will get a refund and the IRS will pay you interest on that refund. That's right. If you made a mistake and you paid in more than you should have, then the IRS will pay you that money back with interest. You tell the client that either way, and then they decide whether or not to amend that tax return. You do not make that decision. So let's say they would owe money and you tell them the consequences of that, that they would owe the money plus some interest and penalties, and they decide, I don't want to deal with it. I'm just going to wait and see what the IRS does. I don't want to amend it. That is their choice, and that is fine. You do not run off and tell the IRS, hey, look, they were supposed to amend this and they didn't. There is something called client tax preparer privilege. It's a confidentiality privilege, kind of like the attorney client privilege that you have likely heard about. We will discuss it more in part 3 of this course. But in any case, you do not work for the IRS, so it is not your duty, nor is it your right to run off to the IRS and tell them about this person who owes money or to tell anyone else. Now, if there has been a crime committed or there has been fraud involved, that could be a different circumstance. We will talk more about that in part 3. But in just a normal routine case of an error, it is the client's decision what to do, not yours. And you do want to know that for the exam. There's likely to be a question on that on the exam. If they do decide they want to fix that error, you do that by filing this Form 1040X, which is an amended tax return that we will be talking about in this course. Other sources of information besides the prior year tax returns. First of all, as an enrolled agent, you are expected to do what is called due diligence to verify, but not to audit, the client information. You are not an IRS auditor. At the same time, you have a duty to file a tax return which is, to the best of your knowledge, true and correct. So, in general, if the client tells you something, you can rely on what they tell you. As long as what they tell you seems reasonable based on their income and their life circumstances, you do not have to question it in general. You do not have to get proof. There are some exceptions where you do have to get proof for certain credits that the taxpayer is taking and certain other circumstances. The IRS actually will require you to get evidence of that. So we will talk about that later. But that's the exception. For most things, if the client tells you something, you can believe it. But you do have to make sure it is reasonable. It has to pass what we call informally the smell test. If you see something that just doesn't seem right, then you want to ask more questions about it. When you're preparing a tax return, you always want to think about what would a well-informed, reasonable tax preparer do in this case. That is the standard that the IRS and the courts are going to hold you to. A reasonable, well-informed tax preparer, what would they do in a particular circumstance? So let's say, for example, you have a client come to you. It is a 30-year-old who has a job and they make $50,000 per year. They've got no interest or dividends. There's no evidence that they've got a large investment account or anything like that. And they tell you that they made a $40,000 charitable contribution during the year. Now, is it possible that they made a $40,000 charitable contribution? Sure, it's possible. But does it seem likely that somebody who makes $50,000 doesn't have any evidence of having any type of savings or investment account? Is it likely that they made a $40,000 charitable contribution? Well, it doesn't seem like it. So, what you would want to do then is say to the client, hey, look, I understand you made this charitable contribution. That's great. But that might raise some red flags with the IRS. Do you have any evidence of that, any receipt or anything like that? So you just want to kind of start asking those questions, see what the taxpayer says, and see whether or not what they are saying is reasonable, and then you can work from there. But again, in general, if what they tell you seems reasonable, just go with it and you don't have to worry about it. So, what are the types of things you are looking to get, the types of information you need? Well, of course, we need their income. Remember, we talked about gross income was the top of that flow chart. So, we're going to need all the information we can about income and also then about expenses so we can figure out any deductions that they have. Same way with credits, any information related to any tax credits. And then there's something called the basis of assets. So if a taxpayer sells something during the year, we need to know whether or not they had any taxable gain or loss from that sale. In order to know that, we need to know how much they paid for that asset. So that leads us to something called their basis of that asset. And then there can be lots of other things that go on the tax returns, things as simple as names and addresses and certain dates that we need for the tax return that we're going to get information about. So let's look at each of these areas in a little bit more detail. Income. We need information about the taxpayer's worldwide taxable and non-taxable income. We need to get a good picture of their income. Even if it is not taxable, it may still need to be reported on the tax return. So we need to know about all of it. How do you get this information? Well, other than just talking to the client, they may have certain forms, such as W-2s. If you've ever had a job in the United States, you are familiar with what a W-2 is. That is the statement you get at the end of the year that shows you how much you made and how much was withheld, etc. Then there can be 1099 forms. Those are those forms you get if you have interest or dividends, or if you have non-employee compensation, reporting income to you, 1099s. Then there can be K-1s. K-1s are forms that come from subchapter S corporations. They come from partnerships. They come from trusts and estates. They report items of income and expense to the taxpayer. So they may have K-1s that you would need. You might be looking at bank and brokerage statements to get information about stocks and bonds and mutual funds, for example. The taxpayer themselves may have records. Maybe they've got a small business and they've got bookkeeping records, or they've got spreadsheets or receipts, et cetera, and so forth. And there can be other information as well, depending on that taxpayer's particular circumstances. Moving on to expenses. For expenses, you can have 1098 forms. So 1099 forms report income. 1098 forms report certain types of expenses. So, for example, if the taxpayer has a mortgage on their home, they will get a 1098 from the bank reporting how much mortgage interest they paid, for example. If there is someone that is in college and paid tuition, there will be a 1098-T that shows the amount of tuition that they paid. And there can be other 1098s as well. Again, we've got the K-1 forms. They can report not only income, but expenses. And there can be receipts that the taxpayer had to show expenses. There can be bank statements that showed amounts that were paid, canceled checks, again, the taxpayer's own records, and etc. As far as basis of assets go, again, we're trying to get to the cost of those assets. If they had real estate that was involved, and let's say they sold a piece of real estate during the year, there would have been a closing statement, both when they bought the real estate and when they sold the real estate. So you'll want to get copies of that. There could be bank or brokerage statements. Again, if we're talking about stocks and bonds and mutual funds that help to establish the basis of those assets. There could be certain forms that the taxpayer was issued, such as a 1099 form that might help, or a K-1 again, or this form 3922, which has to do with stock options from their employer. And there could be other forms that might help to establish their basis in certain assets. Again, they could have receipts, they could have canceled checks, there could have been appraisals that were done, and there could be other information as well. And then we've just got various miscellaneous sources of information. IRS letters. You always want to ask the client, did they get any type of letters from the IRS? And you want to get copies of those. So maybe the IRS discovered an error on last year's tax return, and not every error requires an amended return to be filed. Sometimes, if the IRS discovers an error, they might just send the taxpayer a notice, a letter that says, hey, we found this error, we made these adjustments, and here are your adjusted amounts. Well, you need to know that as the tax preparer. So you just want to make sure you get a copy of any type of correspondence they got from the IRS. Sometimes school records, when we're looking at some of these tax credits, it's good to have school records to show the name and age of the child and that they are in fact in school. So those might be something you would want to look at. Something as simple as a driver's license or other form of identification. If you've got a client that just walks in off the street, so to speak, and you don't know who they are, you want to be able to prove who that person is. There's a lot of fraud out there, a lot of identity theft out there. So you want to know who you are dealing with. So it's good to get a copy of at least one form of official identification so that you can have that for your file. So you can say, yes, I did verify who this person is. And then there can just be other things on the tax return that you would get documents related to that. And that's going to vary from person to person. Moving on now to filing requirements and due dates. Who needs to actually file a Form 1040? Well, I'm glad you asked. Here it is, and you will want to know this for the exam. If you are a U.S. citizen or resident of the United States or Puerto Rico and you meet the filing requirements, then you need to file a Form 1040. The filing requirements are based primarily on income. It's the amount of income that the taxpayer has during the year that decides whether or not they need to prepare a tax return. But there are some instances when, regardless of your income, you also need to file a return. So that's what we mean by other. So remember this for the exam. If you are a U.S. citizen or a resident of the United States or Puerto Rico and you meet the filing requirements, whether it's income or one of the other requirements, then you must file a Form 1040. Non-residents may also need to file a tax return. In their case, they would file a Form 1040-NR. We will look at that later in this video. Income definitions. Before we look at the minimum amount of income that is needed in order to file a return, we need to have a basic understanding of some of these terms. We are going to get into more detail about income in the next video, in video 2 of part 1. But for now, you just need to understand these basic definitions. We've got gross income. Gross income means all income received in the form of money, goods, property, and services that is not exempt from tax. So when you see on these charts and when you're reading these publications, you'll see the term gross income. That's what it means. All income received that is not exempt from tax. It can include income from sources outside of the United States, as well as from inside of the United States, of course. It can include income from the sale of your home, as long as that is not excluded from income. It includes the taxable portion of any Social Security benefits that were received. It includes business gross income, but not losses. It includes capital gains, but not capital losses. Then gross income is going to be broken down into two general types, earned income and unearned income. So earned income includes salaries, wages, tips, professional fees, income from a business that the taxpayer owns. So it's kind of intuitive what earned income would be. The one that's not so intuitive is scholarships and grants. So taxable scholarships and grants are also included in earned income. Most scholarships and grants, as we'll find out later, are not taxable. However, some are. So if you have taxable ones, they are included in earned income. Next, we have unearned income. So this includes taxable interest, dividends, capital gains, unemployment compensation, taxable Social Security benefits, pensions, annuities, and distributions of unearned income from trusts. Now, you might be saying, but wait, Tom, I worked for that Social Security, or I worked for that pension. I earned it. And that is true, but you didn't work for it in this year. You worked for it in a prior year. So this year it is considered unearned income. So when you have the total of your earned and unearned income, you add those together. That is going to equal your gross income. So remember those terms as we are looking at these various charts. And speaking of charts, here is our first one. This chart, by the way, is from publication 17. Remember at the beginning when I said the textbook for all of part 1 is publication 17? That's where this chart comes from. What this is showing you is those minimum gross income amounts that are required for most taxpayers for them to file a Form 1040. So for most taxpayers, we will talk in the next slide about who this does not apply to. But for most taxpayers, you need to make at least this much money in order to be required to file a Form 1040. How much money is going to depend on your filing status. So these are the 5 filing statuses. We are going to get into detail about these later. For now, just take them as they are. But so, for example, a single person who is under age 65, if they have gross income of $15,750 or more, then they need to file a Form 1040. If their gross income is less than that and they do not meet any of the other requirements for filing a return, then they do not need to file a Form 1040. As you can see, if they are age 65 or older, then that amount goes up to $17,750. And then you can see the amounts for the other filing statuses. If they are married filing jointly and under age 65, you can see it is $31,500. Not coincidentally, that is exactly twice as much as it is for a single person because you've got 2 people that are involved here. And then you can see the amounts if they are 65 or older. Married filing separately, you can see if they had $5 or more of gross income, then they need to file a tax return. So virtually everyone who is married filing separately will need to file a 1040. If they are something called head of household, then it is $23,625. That is exactly halfway between being single and being married filing jointly. Then if they are a qualifying surviving spouse, it is $31,500. Not coincidentally, that is the same as the married filing jointly amount because as you will find out later in this video, if you are a qualifying surviving spouse, then you are treated for most purposes as if you were married filing jointly. When you look at these amounts, you are going to see them again when we talk about the standard deduction later in this course, because these amounts, except for the married filing separately, but for the other filing statuses, these amounts are equal to the standard deduction. Because if you have gross income of $15,000 and you're single and you're under age 65, well, your standard deduction is more than your gross income. So that's why you don't need to file a Form 1040. And it's the same with the other filing statuses, again, except for married filing separately. So that was the chart for most taxpayers. Who is not most taxpayers? Well, it is anyone who is being claimed as a dependent on someone else's tax return. So if you are a dependent of someone else, then you do not use that chart we just looked at. You are not considered most taxpayers. Instead, you will use this chart. So let's zoom in to see it a little better. So at the top, it's telling you that if you can be claimed as a dependent, then you don't use that previous chart. Then it's telling you the difference between earned and unearned income that we already talked about. So then you're going to look and see where does your client fit here. If they are single, so they're not married, and they are a dependent on someone else's tax return, then you're going to ask the question, are they either age 65 or older or blind? If they are not, So this is your stereotypical child who is a dependent on their parents' tax return. They're under age 65, they're not blind, and they are dependent on their parents' tax return. When do they need to file their own Form 1040? They need to file it if any of the following apply. If their unearned income, remember that's interest, dividends, etc. If their unearned income was more than $1,350, they need to file their own tax return. Or if their earned income was more than $15,750. So this might be the 16-year-old who has a job. Well, if they earn from that job more than that $15,750, they need to file a tax return. Remember, that's the same amount from the previous chart. If you are single and under age 65, that's the same amount, that $15,750. Then there is this third category as well. So if you don't meet either of those, but you do meet this one, then you also need to file a Form 1040. So if your gross income, so remember, that's the combination of your earned and unearned income. If that was more than the larger of $1,350 or your earned income plus $450. So if your gross income was more than the larger of those two, then you also need to file a Form 1040. Now, this all seems kind of convoluted. So, what's that all about? What they're trying to do is catch people who don't quite fit in to the unearned category, don't quite fit into the earned category. They're somewhere in between, but they earn enough combined earned and unearned income that they still need to file a tax return. That's what this one is doing. So just remember this rule. What about those single dependents who are age 65 or older or blind? So this could be stereotypically an adult child who is supporting their elderly parent. So that parent is age 65 or older, and they are a dependent on someone else's tax return. In that case, if their unearned income was more than $3,350, then they need to file their own 1040. If their earned income was more than $17,750, then they need to file a 1040. Or if their gross income was more than the larger of $3,350 or their earned income plus $2,450, then they need to file their own Form 1040. Then we're going to move down to married dependents. So again, we're going to ask, were they either age 65 or older or blind? If not, so they're under age 65, they are married, and they can be claimed as a dependent on someone else's tax return. This is not particularly common, but it does happen. So in that case, then if their unearned income is more than $1,350, or their earned income was more than $15,750, or if the combination of their earned and unearned income was more than the larger of $1,350, or their earned income plus $450, then they need to file a return. All of those things are exactly the same as if they were not married. Same exact numbers, whether they are married or not, if they are under age 65. The one difference you will notice is if they are married filing separately. If they are married filing separately, then if their income was at least $5 and their spouse filed a separate return and itemized deductions, then they will also have to file a tax return. Next, let's move on to a married dependent who is either age 65 older or blind. This will be more common than under 65 and married because you could have, for instance, elderly parents who are both still alive, they are still married, and their child or children are supporting them, and they are being claimed as a dependent by one of those children. So when do those parents need to file a separate return? Well, if their unearned income was more than $2,950, or their earned income was more than $17,350, Again, the same exact rule as before. If they're married filing separately, the $5 rule, or if their gross income, the combination of earned and unearned income, was more than the larger of $2,950 or their earned income plus $2,050. In this case, these numbers are different than up here if they are not married. So if they're under 65 and married, same numbers as above. If they are over 65 and married, then the numbers are different. So let's talk about the EA exam. There will be, undoubtedly, questions about this. There will be a question that says, for example, which of these taxpayers needs to file a return? And they'll give you A, B, C, and D. And they'll have one of the choices will be Johnny is a dependent on his parents' return. He is not married. He's not blind. And he has a part-time job and earns $10,000. And that's all of his income. So you'll then know that, okay, Johnny does not have to file a tax return because he doesn't have any unearned income and his earned income is less than $15,750. So I know that he does not have to file a return. So you definitely will have questions like that on the exam. The good news is most of the time, those questions are going to be more related to the most taxpayers. So if you can remember these, I would concentrate more on remembering these numbers than on remembering all of the numbers for the dependents. Now, that doesn't mean you should ignore this, and certainly you will want to be generally familiar with these numbers, but spend the majority of your time on the most common situations. Next, let's talk about those other situations. So, when, regardless of your income, you need to file a tax return. So, this is another chart, again from publication 17, that tells us those circumstances. So, first of all, regardless of your income, if you owe any of these special types of taxes, then you still need to file a Form 1040. So, remember, the main thing we're getting at in the 1040 is the income tax. But there are other types of taxes that you also have to pay that are also reported on the 1040. So, regardless of your income, if you owe any of those other types of taxes, you still have to file a 1040. So, first of all, the alternative minimum tax, if you owe that, you need to file a 1040. This additional tax on a qualified retirement plan, if you owe that, you have to file one. If you owe household employment taxes, you will need to file a return. If you owe Social Security and Medicare tax on tips that you did not report to your employer or on wages that you received from an employer who did not withhold those taxes, both of those are going to be a rare circumstance. But if you have that circumstance, you need to file a 1040. Another rare circumstance is if there is any uncollected Social Security and Medicare tax on tips that you reported to your employer or on group term life insurance and additional taxes on health savings accounts. If you have any of those, you have to file a return. And if you have something called recapture taxes, such as depreciation recapture, then you have to file a return. As we go through the course, we will be talking about these things. But just for now, know that if you have any of them, regardless of your gross income, you need to file a tax return. Next, if you or your spouse received distributions from a health savings account or one of these other health types of accounts, then you need to file a return regardless of your income. If you had net earnings from self-employment of at least $400, you will definitely get a question on the exam about this. If you had self-employment earnings of at least $400, then you need to file a tax return. That is because even though you may not owe any income tax, you will owe something called the self-employment tax. So remember that $400 for self-employed income. If you had wages of $108.28 or more, and yes, that is right, that's the number, and you are a church employee. So there are certain church employees that are exempt from having Social Security and Medicare taxes withheld from their paycheck If they earn at least that $108.28 or more, they have to file a return. If you were to get a question on this in the exam, hopefully that dollar amount will jump out at you and you will remember, oh, that's right, church employee, they have to file a tax return. Next, if advance payments of the premium tax credit were made for you on your behalf, then you need to file a tax return. We will talk more about that later in this course. Then we've got this obscure one here. If you're required to include amounts in income under Section 965, etc., then you have to file a tax return. You're not likely to get a question about that. Section 965 deals with deferred foreign income. I wouldn't worry too much about that one. And then lastly, if you purchased a new or used clean vehicle, such as an electric vehicle, from a registered dealer, and you reduced the amount that you paid for the vehicle by transferring your credit. So for 2025, or at least for part of 2025, you can get a credit if you buy an electric vehicle. And sometimes instead of taking that credit yourself, you can just transfer that credit to the dealer. The dealer then reduces the sales price of the car by the amount of that credit, and they will then report that to you for your tax return. So if you had that situation, then you have to file a tax return. So you will want to be familiar with this. Make sure you understand, at least conceptually, these areas where you need to file a return regardless of your income. So now let's do a couple of examples of filing requirements. Example 1, Joey is 21 years old. He's single and cannot be claimed as a dependent on anyone else's tax return. In 2025, he earned $12,000 at a part-time job and had dividend income of $2,500 and interest income of $1,000. Does he have to file an income tax return for 2025? Well, let's think about this. He's single, cannot be claimed as a dependent, so he is most taxpayers. So what's his total income? $12,000 plus $2,500, that's $14,500, plus $1,000 is $15,500. So does he have to file a return? Well, remember, what was that amount? It was $15,750. He earns less than that. So since his total income is less than the $15,750, he is not required to file a tax return. Now, just because Joey is not required to file a tax return, does that mean he is not allowed to file a tax return? No, it does not. He is still allowed to file a return. He's just not required to do so. Now, you might ask, why in the world would someone file a tax return if they didn't have to? Well, there could be a few reasons. First of all, let's think about that part-time job. Joey has $12,000 from a part-time job. They may have withheld federal income tax from his paychecks. Well, he doesn't owe any income tax. So he would like to get that amount refunded. The only way he can get a refund of the amount that was withheld is by filing a tax return. Also, there are certain credits that you can get even if you don't have the minimum amount of income. You can get, for example, the earned income credit, and there are others. And the only way to get those credits is by filing a tax return. So that is another reason. So remember, these requirements only say when you have to file a return. They don't prevent you from filing a return if you earn less. Example number 2. Monica is also 21 years old. She's also single and cannot be claimed as a dependent on anyone else's return. In 2025, she also earned $12,000 in her grass cutting business, and she had dividend income of $2,500 and interest income of $1,000. Does she have to file an income tax return for 2025? Well, her situation looks a lot like Joey's. Same amount of income. She's got $12,000 plus $2,500, that's $14,500, plus $1,000 is $15,500. On the surface, she looks just like Joey. But Is there a difference? Is there something that might require her to file a tax return? And I'm sure you figured it out. Yes, there is. Her $12,000 did not come from a job. It came from her own business. Remember, if you have self-employment income of $400 or more, you have to file a tax return regardless of your other income. So yes, since her self-employment earnings are more than that $400, Monica does have to file a tax return for 2025. So now let's move on to the filing deadline. When is the Form 1040 due? And I bet you already knew the answer to this one. It is due on April 15th. So the rule is that the 1040 is due on the 15th day of the fourth month following the end of the year, which makes it April 15th. If April 15th falls on a weekend or a holiday, then it is the next business day. So, for example, if April 15th is on Saturday and Monday is not a holiday, then Monday would be when that tax return is due. However, for the 2025 tax return, which is what we're dealing with on this exam, it is due on April 15th of 2026, which happens to be a Wednesday. All of the due dates that you're going to see in this course, we're going to be talking about various types of returns that have various due dates. Anytime you see a due date, this rule applies about the weekend or holiday. So if that due date is on a weekend or holiday, then you go to the next business day. So you want to keep that in mind as you go through this course. Now, it is possible to get an extension of time so that it is not due on April 15th, but instead is due 6 months later on October 15th. You get that extension by filing this form 4868. It is called an automatic extension because you do not have to have a good reason to do it. You don't have to have any reason at all. If you file the form, the IRS will grant you that extension. But you do have to file the form in order to get the extension. Very importantly, though, it is only an extension to file the return. It is not an extension to pay the tax. You still need to pay any balance due by April 15th. And you're probably thinking, well, Tom, if I don't have all the information I need in order to file my return, or I haven't even looked at it yet, how in the world am I supposed to know whether or not I have a balance due? Well, the answer is you are going to have to do your best to estimate it. This is one of the services you can provide for your clients, is to do an estimate based on the best information you have. And then when you file that form 4868, you will pay tax with it. You just make the best estimate that you can. If you do not, so if you file for the extension, you don't pay that amount in, you end up owing tax, then you will owe interest and penalties for not paying on time. If you have a refund due, then of course you don't have to worry about it. You can just file the 4868 and then file your return by October 15th. By the way, October 15th has the same rule, the same weekend or holiday rule, but in 2026, October 15th is on a Thursday, as it turns out. So October 15th of 2026 is, in fact, the extension date for the 2025 tax return. There are certain cases where you do get a truly automatic extension where you don't have to file the form. The first is if you are living outside of the United States and your main place of business or post of duty, if you're in the military, is outside of the United States. In that case, you get an automatic 2-month extension to June 15th of 2026. So you don't have to file the 4868. And as long as you file by June 15th, then you are good to go. And again, June 15th is a Monday, so that is the correct date. But importantly, this again is not an extension to pay. So by April 15th, you're going to have to at least do an estimate to see whether or not you are going to owe. And if you are, then you still need to pay in by April 15th. So what we usually will do in that case is just file the 4868 on or before April 15th and pay in that amount that is due. If you do not have an amount due, you've got a refund and you want a further extension beyond June 15th, you can get that up to October 15th, again, by filing the Form 4868. You need to file that on or before June 15th. Also, going back to these requirements, remember, this is for a U.S. citizen or resident who is living and working outside of the United States. Not just working, but their place of business is outside of the United States. So if you're just on a business trip on April 15th, you do not get this extension. Or if you're just on vacation, you do not get this extension. You have to be living and your place of business is outside of the United States in order to get this automatic extension. Our next exception to the April 15th filing deadline is if you are in a presidentially declared disaster area, then the IRS will give you an extension of time to both file and pay your tax. I think they figure if you're dealing with a disaster, then they're going to go ahead and give you a break. The date for this is not automatically determined. The IRS will determine that date based on the circumstances. Obviously, every disaster is going to be a different situation. So the IRS will make an announcement that says the people that are living in these particular disaster areas, it's usually based on the county where you live. They'll say those people have an extension until, and they'll name a date. Might be May 31st, it might be July 15th. Whatever they say, that will be the date. Then you have until that time to both file and pay your tax. This is for both individual and business taxpayers who live in that disaster area or whose tax records are in that disaster area, and relief workers. So maybe you live in one county, but you have a business that's in a different county, and those business records are going to affect your Form 1040. Well, those business records are in the disaster area, then you would also get that automatic extension of time to file your tax return. It also applies to relief workers. So if you are with the Red Cross or some other relief organization and you are working in that disaster area, then you also get that extension of time to file. Next is the combat zone exception. So if you are serving in a combat zone as designated by the president, then you get an automatic extension of time to file. This applies not only to people in the military, but also to civilian support personnel, as well as Red Cross personnel, and even certain correspondents like press correspondents who are covering the war. They also get this extension. It is an extension of time to file and to pay the tax. And here is how you compute it. You get a combination of these two things: 180 days from the later of your last day in the combat zone or your last day of a qualifying hospital stay due to an injury in the combat zone, plus the number of days before April 15th that you entered the combat zone. So that can be up to an additional 3.5 months. So let's do an example. Nick is in the military and entered a designated combat zone on January 31st of 2025 and served without injury through March 31st of 2026. Nick's 2025 tax return is due 254 days after March 31st of 2026. So remember, you get 180 days from your last day in the combat zone. The last day was March 31st of 2026. So first he gets 180 days from there. Then he gets an additional 74 days because he entered the combat zone, remember, January 31st of 2025. So February 1st of 2025 through April 15th of 2025 is 74 days. So he gets that total of 254 days after March 31st of 2026, which is December 10th of 2026, which is a Thursday. So that is the due date for Nick's tax return, due date for filing and for paying the tax. So you will want to remember that rule for the exam. Now let's talk about penalties. What if you do not file your return on time, whenever that due date may be? For most of us, it's going to be April 15th. Well, there is a failure to file penalty, and that penalty is 5% of the balance due per month or part of a month, up to a maximum of 25% of the balance due. So if someone owes, let's say, $10,000, 5% of that, if my math is right, is $500. So that is $500 per month. So let's say they file 4 months and 1 day late. They have to pay 5 months worth of penalty. So that would be $500 a month for 5 months is $2,500. That would be their penalty. Even if they are 6 months late, their maximum is still going to be that $2,500. If, however, there is fraud involved, instead of 5% of the balance due, it is 15% of the balance due, up to a maximum of 75% of the balance due. If the return is more than 60 days late, then you're going to have a minimum penalty that is going to kick in. That minimum is the smaller of $525 or 100% of the unpaid tax. So let's say you had a taxpayer, for instance, who owed $400. If that is more than 60 days late, remember, if they had $400, their 5% penalty would be, what is that, $20 per month. But if they are more than 60 days late, so that's more than 2 months, their normal penalty may have only been, let's say, 3 months worth. It may have been $60. However, because they are more than 60 days late, they have to pay the smaller of their balance due, or $525. So in this case, their penalty would be $400 because that was the amount that they had due. If you get an extension, but you do not file by the extended due date, then the penalties start back on the original due date. So let's say you get that automatic extension to October 15th, but you don't file until December. The penalties are going to start on April 15th, not October 15th. Very importantly, all of these penalties that we're talking about here, this failure to file penalty, is based on the balance due. So if there is no balance due, if you've got a refund, or if it's zero, no amount owed, no balance due, then there is no failure to file penalty. Next is the failure to pay penalty. So maybe you file the return on time, but you don't pay the tax. So you would have a failure to pay penalty. That penalty is 1/2 of 1% of the balance due per month or part of a month, up to a maximum of 25% of the balance due. So let's say you had $10,000 that was due. 1/2 of 1% of that is $50 for each month or part of a month. And that can keep going on and on and on until you get all the way up to $2,500. What if you extended your return and you made a payment with that extension? What happens then? Well, if you paid in at least 90% of what the balance due was, then there will be no penalty. So let us say that you estimated that your balance due was going to be $10,000. So you paid in $10,000. As it turns out, when you did your return, the balance due actually was $11,000. Well, $10,000 is more than 90% of $11,000. So what they're saying is we're not going to charge any failure to pay penalty for that. In other words, you made an estimate, you did a pretty good job of it. You weren't perfect, but you did a pretty good job. So we are not going to impose a penalty for that. And then again, if there is no balance due, then there is no penalty. So these penalties are based on the balance due. What if you have both penalties? What if you didn't file and you didn't pay? Well, then you do have to pay both penalties. However, it's not as bad as it sounds because the failure to file penalty is reduced by the failure to pay penalty, which means your combined penalty is the same as the failure to file penalty, which is 5% per month. Now, having said that, once you reach the maximum failure to file penalty, the failure to pay penalty can continue on. So we reduce the failure to file penalty by the failure to pay penalty. But once the failure to file penalty is maxed out, the failure to pay penalty, that 0.5%, will continue on. And the greater than 60-day rule does still apply. So that's that smaller of $525 or 100% of the tax due. Interest. If you do not pay on time, then interest is going to be charged on the amount that was due. And it will be charged even if you get an extension of time for filing, because remember, it is not an extension of time to pay. Now, if you meet one of those exceptions where you have an extension of time to pay, then they will not charge interest, but otherwise they will. Remember, there's also going to be penalties that we just talked about, and they will charge you interest on the penalty as well. So if you do not pay on time, not only are you going to be charged a penalty, not only are you going to be charged interest on the amount that was due, you are also going to be charged interest on the penalty. So if you don't pay and you had a large balance due, this can really add up very quickly. The interest rates that are charged are based on the federal short-term rate. You want to remember that. They are compounded daily. You want to remember that. And they are updated quarterly. So you are likely to get a question on this. They are going to ask, for instance, they will say the interest rates compound, and then they will say A, annually, B, quarterly, C, monthly, or D, daily. And you need to know that it is daily. They compound daily. They are updated quarterly. What that means is the IRS will announce every quarter, they put out these rates. They say these are the rates for this quarter for interest, and those are going to be based on what is called the federal short-term interest rate. Interest can, in some fairly rare circumstances, be forgiven so that you don't have to pay the interest, but that is only true if the reason for the delay in paying was due to an IRS error or delay. So we'll talk much more about that in part 3 of this course, but know that in certain circumstances, that interest can be forgiven, but I will tell you that does not happen very often. And another penalty we want to talk about is a very important one. It is the penalty for perjury. So knowingly filing or helping to file a false return or aiding in fraud is a felony. And the maximum fine for that is $100,000, and or you can do up to 3 years in prison. You will definitely be asked a question about this on the exam. Maybe in part 1, maybe in part 3, maybe in both part 1 and part 3, but you will be asked this question. The IRS wants to make sure that you know that filing a false or fraudulent tax return is a serious crime. It is a felony, and you can be fined up to that $100,000 and or up to 3 years in prison, and that is for every count. So if you have a tax preparer who is fraudulently filing lots and lots of tax returns, that can add up to lots and lots of fines and lots of time in prison. The IRS wants you to know that. So they are going to ask you this on the exam. And this applies, of course, not only to you as the preparer, but it applies to the taxpayer themselves. So the taxpayer files a false or fraudulent return knowingly, then they are facing the same fines and imprisonment. So now let's move into talking about the top section of the tax return. So in that top section, you've got the basic information that's needed to file the return. Name, address, social security number, etc. is all there. So let's have another look at the top section of that tax return. So starting off, first of all, let's look up here at the very top. You're never going to have to look at this again, but you should understand what it means. For the year January 1st to December 31st, 2025, or other tax year beginning on blank date, ending on blank date. Individual taxpayers are calendar year taxpayers. When we get into talking about businesses, many businesses will have a different tax year other than the calendar year called a fiscal year. Individual taxpayers are 99.99% of the time calendar year taxpayers. It is theoretically possible to have a different tax year. That's why this is on here. However, you are likely to go your whole career without seeing anything other than a calendar year. Even if the taxpayer dies during the year, they can still treat it as if they were alive all year. And so it's still going to be a calendar year. But that is on there just in case you have that rare example. Next, you're going to see these. These boxes are actually new in 2025. They have not existed before. If you're in a combat zone, remember we talked about that, and then the IRS wants to know that because you get that special extension. If the taxpayer died during the year, then you are going to check the box and put the date that the taxpayer died. There's also this other box. This again is pretty obscure. There are some other extensions that you get, kind of automatic extensions if you make certain tax elections. You would check this box. If you have one of those, don't worry about the details of that for the exam. And then there is this other box, which the IRS can use if they ever need it for any other purpose. Then you've got the taxpayer's name and social security number. If they're married, then you put the spouse's name. If they are married, you can put either spouse first and either spouse second. It does not matter. If you see on the tax return, if it says you, then that is referring to who is ever named first. And if it says your spouse, then that is referring to who is ever named second. But it does not matter which spouse goes on which line. Then you've got your address. You want to put the taxpayer's current address. So sometimes they'll think, well, wait a minute, at the end of 2025, I actually lived at this address, but now I've moved and I lived at a different address. Which address do I put? You want to put their current address. Think about it like this. If the IRS was going to send you a check, would you want them to send it to your current address, or would you want them to send it to where you used to live? Well, of course, you want them to send it to your current address. So that is the address you're going to put on the tax return. If they live in a foreign country, then you would put that information there as well. Then you're going to see there are some check boxes. We will talk about those check boxes later. And there's also a place for their filing status. We're going to be talking about the filing status. And then there is this box about being a non-resident alien. We are going to be talking all about that as well in this video. Then we have this section for dependents, and this is revised for 2025. There is more information here than used to be required. So you've got their name, you've got their social security number, and their relationship to you. That is the same as we had before. But now you've got this box, check if lived with you for more than half of the year, because that is important for various things. And so they want to see that right here on the front of the 1040. And then check if they're a full-time student or permanently disabled. That's important for determining whether or not they are a dependent. And then check if you are taking certain credits. So there are certain credits, and they want to know, are you taking the credit for that particular dependent? So you would check those boxes. And then there is another checkbox here about living apart from your spouse for the last 6 months, and you will see later why that is important. So now let's get into more detail about the various parts of this return, starting with the Social Security number. So everyone on the tax return, the taxpayers, the dependents, need to have either a Social Security number or a taxpayer identification number known as a TIN. So again, they have to have one or the other. Most of them are going to have a Social Security number, and this is required for dependents of all ages. So if you've got a dependent on the tax return, then you need to show their Social Security number or their TIN. The only exception is if you have the unfortunate circumstance of having a baby that was born and died in 2025, then they do not need a Social Security number, but all of the other dependents do. The ITIN, so the individual taxpayer identification number, this is going to be for people who cannot get a Social Security number. So it is going to be for non-resident and resident aliens who are not eligible for a Social Security number. This includes the children and dependents. So again, everybody on the return needs to have either a Social Security number or a taxpayer identification number. In order to get this ITIN, you're going to file this Form W-7 with the IRS, and it is used for tax purposes only. So it does not give them the ability to work in the United States. You can't use it for identification. It is only for filing the tax return. The other type of TIN that you could have is an ATIN. It is an adoption taxpayer identification number. So while the taxpayers are in the middle of adopting a child, they're not going to be able to get a Social Security number for them until that adoption is final. But that child might still qualify as a dependent on their tax return. So you can apply for this adoption taxpayer identification number, the ATIN. Get that by filing Form W-7A with the IRS. Next, let's talk about tax residency. We've talked a little bit already about being a resident alien or a non-resident alien. So what does all that mean? Well, an alien in the tax law is any non-US citizen. So there are three types of aliens. You can be a resident alien, a non-resident alien, or a dual status alien. If you are dealing with this population with a lot of aliens, whether they are resident aliens or non-resident aliens, then you will want to look at Publication 519, U.S. Tax Guide for Aliens. And so that's where this information is coming from. So let's talk first about resident aliens. Resident aliens are taxed on their worldwide income, just like U.S. citizens. And an alien is considered to be a non-resident alien by default. So the default is that a person is a non-resident alien unless they meet one of these two tests called the green card test or the substantial presence test. Now, from a taxpayer's standpoint, it is actually better to be a non-resident alien because, as you'll find out, non-resident aliens are only taxed on their U.S. source income, whereas resident aliens are taxed on their worldwide income. So these two tests will determine whether or not someone is, in fact, a resident alien and therefore taxable on their worldwide income. First, the green card test. This is for a lawful permanent resident. They will have a permanent resident card, also known as a green card, due to its color. So this one is pretty straightforward. Talking to your client, are you a lawful permanent resident? Yes. Can I see your green card? And then that is something you will probably want to get a copy of. It will help to establish their identity and to show that they are, in fact, a lawful permanent resident and they are a resident alien. Next is the substantial presence test. So even if they don't have a green card, they could still be a resident alien. First, they must be physically present in the United States on at least 31 days during the year. So we're talking about 2025. So they had to have been present in the United States for at least 31 days during 2025 and 183 days total during the 3-year period that includes the current year and the 2 years immediately before that. However, we don't count 183 days in the normal way that you would count days. We have a special way that we count those days. We count all of the days in the current year. So for 2025, we count every day. Then we count only 1/3 of the days for the prior year. So that would be 2024. And we count only 1/6 of the days for 2 years before, which would be 2023. So let's look at an example. Bjorn was physically present in the United States on 120 days in each of the years 2025, 2024, and 2023. So we know right away that Bjorn meets this first rule. He had 120 days in 2025, so we know he meets the 31-day rule. To determine if he meets the test, though, we need to look at the prior years. So in 2025 was 120 days. So we're going to count those towards this 183 days. 2024, we're only going to count 1/3 of the days, which is 40. And in 2023, we're only going to count 1/6 of the days, which is 20. So if you add up all of that, 120 plus 40 plus 20, that is 180 days. That is less than 183 days. Therefore, Bjorn is not considered a resident under the substantial presence test. So he would be a non-resident alien. When we are doing the substantial presence test, there are some exceptions. So when we're counting the days, you do not count any days that the person is an exempt individual. So what does that mean? Well, if they are temporarily present in the United States as a foreign government related individual, so they might work for a foreign government, they are in the United States on assignment for their foreign government. So we're not going to be counting them as resident aliens who are taxed on their worldwide income. So what we're saying is for those people, we're not going to count them. We're not going to count those days. Even if they were here 365 days, doesn't matter. That doesn't count. They are not going to be considered a resident alien. So they've got this specific thing here if they had an A or G visa. So those are special visas for foreign government officials. If they had that, we don't count the days. Or if they were a teacher or a trainee who was temporarily present in the United States under a J or Q visa, then also they are not going to be considered residents. Or if they are a student who is temporarily present in the US under an F, J, M, or Q visa, or if they are a professional athlete temporarily in the US to compete in charitable sports events, then they are not going to count those days towards being a resident. So what we're looking at here is people who are either here as an employee of a foreign government or as a student or a teacher, and they're just here for a temporary period of time. It may have been more than 183 days, but it's still temporary. They have no intention of becoming a U.S. citizen, and the United States government is not going to tax their worldwide income. And then they've also got this professional athlete who is competing in a charitable sports event. We're not going to count those days against them either. We also do not include any days that the person was unable to leave the United States due to a medical problem that arose while they were in the United States. So let's say they were coming to the United States for a short vacation and they were in an automobile accident and they ended up in the hospital. So they ended up being here for an extended period of time. We're not going to count those days and make them pay tax on their worldwide income because of that. There is another exception to that substantial presence test. This is called the closer connection exception. If the taxpayer has a closer connection to a foreign country than they do to the United States, that's when this kicks in. So first of all, they had to be present in the United States for less than 183 days. So if they were here for 183 days or more, then that's going to count, and that could then make them a resident alien if they meet all of the other tests. So for this closer connection exception to apply, they had to have been here less than 183 days in the current year. So we're talking about 2025. In addition to that, they had to have had a closer connection to a foreign country than to the United States. So basically, they had to have lived, their house and their family and everything is really in the foreign country. So that's where their vehicles are all registered. That's where their residence is. So they had a closer connection to that country than to the United States. They have to have maintained a tax home in that foreign country. So, as far as the foreign country is concerned, they are a resident of that other country. And so they're going to be paying taxes in that other country. That's what that means. And they have not taken any steps toward becoming a lawful permanent resident. In other words, they're not trying to become U.S. citizens or permanent residents. So if all of those things are true, they're just here in the United States temporarily, was less than 183 days. Their home is really in a foreign country, then we are not going to count any days that they stayed here this year towards the substantial presence test. And then the next one is a closer connection to two foreign countries. So it's the same idea, except that they move during the year. So they move from one foreign country to another foreign country during the year, but they still have a closer connection to those countries than they do the United States. Same thing, we're not going to count those days towards the substantial presence test. There's also a different, slightly different, closer connection test for students. If they are a student that is temporarily here in the United States and they do not intend to stay in the United States, and they have a closer connection to a foreign country than to the United States, just like we talked about before, then even if they were here for 183 days or more, we are not going to count them. So if you're not a student, then you have to look at that 183-day requirement. If you are a student, I mean, it's understood. You're here, you're going to school, you're likely to be here for more than 183 days. But if your tax home is in another country, you don't intend to stay in the United States, you're following all of the immigration laws, you're doing everything you're supposed to do, then we are not going to count you as a permanent resident who has to pay tax on their worldwide income. That's what this is saying. So now let's talk about non-resident aliens. As we said before, non-resident aliens are taxed only on their income from sources within the United States and on certain income connected with the conduct of a trade or business in the United States. So I am just going to call that United States or U.S. source income. Those people may need to file a Form 1040-NR that we'll look at here in a minute. If there is a non-resident alien spouse, so this is one of those check boxes that's at the top of the 1040. So if you have a U.S. citizen or resident alien, if they have a spouse who is a non-resident alien, so they don't have their green card, they do not meet the substantial presence test, but they are married to a U.S. citizen or a resident alien, you can choose to treat that non-resident spouse as if they were a resident alien. So if you think about it, the IRS doesn't care. So if you've got, let's say, a resident alien and their spouse is a non-resident alien, the IRS is fine with treating the spouse as if they were a resident alien. Why? Because the resident alien is taxed on their worldwide income. The non-resident alien is only taxed on their U.S. source income. So the IRS is either going to be ahead or the same. They don't lose anything by treating that non-resident spouse as if they were a resident. So you are allowed to do that if you want to. So what about that Form 1040-NR? So let's have a look at that. You will notice that it looks a lot like the regular 1040. It's got a lot of the same information. You can also see here, though, it can be filed actually by an estate or trust. So it's not just for individuals, but you're going to see a lot of it looks exactly the same. You're going to put your income and you're going to come down to your adjusted gross income, just like with the 1040.
And then you're going to have your itemized deductions. Most non-residents cannot take a standard deduction. We'll talk about that later, but you will have your itemized deductions and you can have other types of deductions as well. Going to come down to your tax. You're going to say how much you paid in or how much is withheld, how much was overpaid, or how much you owe. So all of it looks very familiar. But of course, remember, this is only going to include U.S. source income because they are non-resident aliens. Our next status is a dual status alien. So it is possible to be a non-resident alien for part of the year and a resident alien for part of the year. Usually this is going to happen in the year of arrival to the United States or the year of departure from the United States. So for the part of the year that they are a resident alien, they are taxed on their income from all sources, just like any other resident alien. So they are taxed on their worldwide income. And we look at when they received the income. So if they received the income while they were a resident alien, even if it's from outside of the United States, then they are going to be taxed on that income. For the part of the year that they were a non-resident alien, if they received that income during that part of the year, then if it's from outside the United States, they will not be taxed on that income because for the part of the year that they are a non-resident alien, they are taxed on income only from U.S. sources. So dual status alien is pretty easy to understand once you understand what a resident alien is and a non-resident alien. It's just that they are one for part of the year and they are the other for part of the year. So let's do a recap of this whole tax residency thing. Remember, what is an alien? It is any non-US citizen. And then there are three types: resident alien, taxed on worldwide income; non-resident alien, taxed only on their US source income; and a dual status alien who's taxed on their worldwide income while they're a resident, taxed only on their US income while they are a non-resident. And again, if you want more information, look at publication 519. Our next topic is filing status. So we've referred several times already to filing status. So let's look at that in some detail. There are 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Qualifying surviving spouse used to be called qualifying widow or qualifying widower. They changed it back in 2022. Sometimes if you're out doing research and Googling around, you may still see qualifying widow or widower. Just know that that now is qualifying surviving spouse. Also, these abbreviations, S for single, MFJ for married filing jointly, etc., get used to those. It's a lot easier to put that than to type out the whole thing on these slides. So as we go through the course, you are going to see these, and these are what they mean. So make sure that you are familiar with them and know what we are referring to. So let's talk about each of these. Single. Single means you are not married on December 31st, 2025. Anytime we are talking about marital status, what counts is your status on December 31st, 2025. So if you were married all of 2025, but your divorce became final on December 31st, 2025, then you are not married for 2025. It is the last day that counts. This includes if you were widowed before 2025. If you were widowed during 2025, so your spouse died during 2025, you are considered married for 2025. But for the subsequent years, you are considered not married unless, of course, you have remarried in the meantime. So single means not married on the last day of the year. Married filing jointly. In order to file married filing jointly, you must have been married on or before December 31st of 2025. So you could have been single all year, got married on December 31st, 2025. You are considered married for all of 2025. And again, Even if your spouse died during 2025, you're still considered married and you can file married filing jointly. In order to file married filing jointly, both spouses must agree. If either spouse does not want to file married filing jointly, then you cannot file married filing jointly. You would then file married filing separately, which we'll talk about next. If you do file married filing jointly, you are going to report your combined income and allowable expenses. You are essentially considered to be one taxpayer for purposes of the tax law. And both spouses are generally going to be liable for the total amount due. It is called joint and several liability. Both spouses are liable for the whole amount due. It's not like one spouse is liable for half and the other spouse is liable for the other half. Both spouses are liable for 100% of the amount due. Married filing jointly is almost always a more favorable tax treatment than married filing separately. You can run it each way. If you've got good professional level tax software, you should be able to run the return either way, either as married filing jointly or married filing separately, and you can see which one comes out better. Almost always it's going to come out better to be married filing jointly, or at least not worse to be married filing jointly, though there can be exceptions to that. There can also be reasons that people don't want to file jointly anyway. We'll talk about that later. If you file married filing jointly, you cannot later then amend your tax return to file separately after the due date is passed. So once April 15th has passed, you cannot go back and file married filing separately. Technically, if you filed, let's say in March, married filing jointly, you could file married filing separately as long as you filed that new return by April 15th. But if you don't do it by April 15th, you cannot go back and amend to file separately. You will want to remember that for the exam. So let's talk about married filing separately. You must again be married on or before December 31st. If you file married filing separately, each spouse files their own return with only their own income and expenses, and each spouse is liable only for the amount on their own return. As we said, this is almost always going to be less favorable tax treatment than married filing jointly. And very importantly, you cannot elect to file as single. If you are married as of December 31st of 2025, you need to file as a married person, either married filing jointly or married filing separately. There's one exception to that when we get to head of household, but other than that one exception, if you're married as of the end of the year, you need to file as a married person. If you file married filing separately, you can amend later to file as married filing jointly, as long as you do so during the normal amendment period, which is usually 3 years from the original due date. So remember for the exam, if you start out as married filing jointly, you have to stay married filing jointly. You cannot amend. If you start out as married filing separately, you can amend later to married filing jointly. Our next filing status is head of household. First, to be head of household, you must be unmarried as of December 31st, 2025, just like we talked about for single. Now, you'll see it also says or considered unmarried. So set that aside for a moment. We will talk about that. But the general rule is you have to be unmarried in order to be head of household. Also, you must pay more than half the cost of keeping up a home for the year. And there must be a qualifying person that lives with you for more than half the year. And we'll talk later about what a qualifying person is. When we say they have to live with you for more than half the year, we do not count temporary absences against you. So, in other words, if you have a child that's living with you and they are away at school for part of the year, as long as their official home is still your home, then you don't count the time they're away at school against that more than half the year. Also, if the qualifying person is a dependent parent, then they do not have to actually live with you. So, in general, a qualifying person has to live with you for more than half the year in order for you to be head of household. But there is this one exception. If that qualifying person is your parent and that parent is a dependent on your tax return, which we'll be talking about dependents here in a little while, then they don't have to live with you. That is the one exception to the living with you rule. And the benefit of being head of household is that it is a lower tax rate and a higher standard deduction than either single or married filing separately. So, not going to give you the same benefit as being married, but they're acknowledging that, okay, you've got this person living with you. So, we're going to give you a little bit better deal than just being a single person who does not have this qualifying person living with them. So now let's go back to that considered unmarried. Remember, in general, you have to be unmarried to be head of household. However, you will be considered to be unmarried if you meet all of the following tests. First, you have to file a separate return. Second, you have to have paid more than half the cost of keeping up the home. Third, your spouse did not live in the home for the last 6 months of the year. In here, you don't get to count temporary absences in your favor. So it kind of works the other way. If your spouse is just out of town on business for the last 6 months of the year, that does not count for this rule. It has to be that their actual home is not your home for the last 6 months, not just that they're out of town for the last 6 months. So they have to have a separate home from you for the last 6 months of the year. Also, then the taxpayer's home has to be the main home for their child, stepchild, or foster child for more than half the year. So this instance, in order to be considered unmarried, it cannot be anyone other than your child or stepchild or foster child that is living with you. A qualifying person for a head of household can be someone else. We'll talk about that in a little while. So the qualifying person for head of household doesn't necessarily have to be your child. But to be considered unmarried, it does have to be your child. It's two different tests. Then the last criteria is that the taxpayer has to be able to claim the child as a dependent. So we're going to talk in a little while about dependents and what it means to be a dependent. So in order to be considered unmarried, not only does the child have to live with you for more than half the year, you also have to be able to claim them as a dependent. Now, that doesn't mean that you actually claimed them as a dependent. So there can be circumstances where even though you are able and you are qualified to claim them as a dependent, you do not do so because the non-custodial parent, the other parent, claims the child under these rules for separated parents that we will be talking about. But the rule here is that you had to have been able to claim them, even if you did not actually claim them. So if you meet all of these tests, then even if you are legally married on the last day of the year, then you can still qualify for head of household as long as you meet all of the other head of household tests. So when we talk about the cost of keeping up a home, remember we said you had to pay more than half the cost of keeping up a home for the year. So what does that mean? Well, it includes the things related to the home itself. So rent, mortgage interest, real estate taxes, homeowners insurance, repairs to the home, utilities, and food eaten in the home. So like the groceries in the home, not dinners out. All of that will be considered costs of keeping up the home. It does not include clothing, education, medical treatment, vacations, life insurance, transportation, or value of services provided. So those things, at least some of those things, may count towards supporting the person for being a dependent. So we'll talk about being a dependent and that you have to support that person. Clothing, education, medical treatment, those are going to go into supporting the dependent, but they don't count as costs of keeping up the home. Costs of keeping up the home have to do with things specifically related to the home. So now let's talk about that qualifying person. What does it mean to be a qualifying person to get head of household status? Well, there's three different categories of people who could potentially be a qualifying person. Could be a child, could be a parent, or it could be an other qualifying relative other than a parent. So let's start with the child. A qualifying child is going to be, for instance, a son, a daughter, or even a grandchild. So it could be your child, could be your grandchild. If that child is not married, then they are automatically a qualifying person for head of household. So this is the most common situation that you're going to see, and it is the simplest situation. If they're your child or your grandchild, then they qualify for head of household purposes. Doesn't mean the person qualifies for head of household. Remember, they've got all the other things they have to meet to be a head of household. But as far as having the qualifying person, the child definitely counts. If the child is married, and you can claim them as a dependent on your tax return, then they are also a qualifying person. The only time a child will not count as a qualifying child is if they are married and you cannot claim them as a dependent on your tax return. Otherwise, a child is a qualifying child. Next is your mother or your father. And this one's pretty simple as well. If you can claim them as a dependent, then they are a qualifying person. If you cannot claim them as a dependent, then they are not a qualifying person. And again, we'll be talking about what it means to be a dependent coming up. So again, pretty easy. If they're a dependent, qualifying person, not a dependent, not a qualifying person. And then last is a qualifying relative. In order to be a qualifying relative, they have to have lived with you for more than half the year. But of course, that's the rule anyway. Any qualifying person had to live with you for more than half the year. And they had to have been related to you in a special way, a way that is on this list. Relatives who don't have to live with you. Don't get caught up on the name, don't have to live with you. That's just the name of the list. We will be looking at it later. The important thing to remember is they have to be related to you in one of the ways that is on this special list. And you have to claim them as a dependent. So, in order to qualify for a qualifying relative, they have to be on the list and you have to claim them as a dependent. If they are a qualifying person. If they're not on that list, or if you do not claim them as a dependent, then they are not a qualifying person. Now, these other three boxes here are redundant because what this says is if your relative did not live with you for more than half the year, then they're not a qualifying person. Well, we already said that up here. They had to have lived with you for more than half the year. Then this says if they're not related to you in a way that's on that list, then they're not a qualifying person. Well, we already said that up here. And this says if you cannot claim them as a dependent, then they are not a qualifying person. Well, we already said that up here. So as long as you have this top box down, then you understand the qualifying relative rule. So remember again, three categories: child, parent, other relative. Child is easy. They always count unless they're married and you cannot claim them as a dependent. Parent, easy. If they're a dependent, they count. They're not a dependent, they do not count. And then the qualifying relative, a little bit more complicated, but really not that tough. If they're on the list of qualifying relatives and they are a dependent, then they are a qualifying person. So that is qualifying person for head of household status. Then our final filing status is qualifying surviving spouse. So this is designed for a widow or widower who has at least one dependent child. It allows them to use the married filing jointly tax rates, standard deduction, etc. It applies to the 2 years following the year of death. So if the person died in 2025, they're going to file as a married person, either married filing jointly or married filing separately, either way. For 2026 and 2027, as long as they have a dependent child and meet the other criteria, then they can file as a qualifying surviving spouse. After 2027, they would no longer qualify as qualifying surviving spouse, even if they do still have one or more dependent children. They might then qualify, for example, for head of household, but they would not qualify for qualifying surviving spouse. So, what are the eligibility rules? First of all, they had to have been entitled to file a joint return with their spouse for the year. Even if they didn't, they may have chosen to file separately, but as long as they could have filed jointly, then that counts. Secondly, their spouse had to have died in either 2023 or 2024 and has not remarried by the end of 2025. So they have to still be unmarried, and their spouse had to have died in one of the prior 2 years in order to qualify. Then they have to have a child or a stepchild and can claim them as a dependent. Then you're going to see this exception, or could have claimed them as a dependent, except that for 2025, the child had gross income of $5,200 or more, the child filed a joint tax return, or the taxpayer themselves could be claimed as a dependent on someone else's tax return. So, what this is saying is you're claiming your child as a dependent unless the only reason you didn't claim them as a dependent is for one of these reasons. Then you still meet the eligibility as a qualifying surviving spouse. Next requirement is that that child or children lived in the taxpayer's home all year. So it's not just more than half the year. They have to have lived in the home all year. But again, we don't count temporary absences against them. If they're away at school or for work, that does not count against them. They're still considered to be living in your home. And you have to have paid more than half the cost of keeping up the home. So they lived with you all year, had to pay more than half the cost of keeping up the home. So if you meet all of that criteria, then you are a qualifying surviving spouse. In the real world, it's usually pretty easy. You're going to see the widow or widower, their spouse died within the last couple of years. They've got their child living with them. They take them as a dependent, and it's pretty much a slam dunk. They qualify as a qualifying surviving spouse. Or they don't qualify because maybe it's been more than 2 years since their spouse died, and okay, they don't qualify as a qualifying surviving spouse. So it's actually usually pretty easy to determine whether or not they qualify. So when we're looking at filing status, there is a hierarchy of which ones are better and which ones are worse. So we start with married filing jointly, that's the best, and then qualifying surviving spouse. For most purposes, these are exactly the same. There's actually a few cases where it's a little bit better to be a married filing jointly than qualifying surviving spouse. But for the vast majority of times, these are equal to each other. Next is head of household. Then you've got single. And then at the bottom is married filing separately. So if you have a choice, and sometimes you do, sometimes the person qualifies for more than one. So you would want to look at this hierarchy to see which one should you choose. So let's look at that. If you qualify for both qualifying surviving spouse and head of household, then you want to choose qualifying surviving spouse. If you qualify for both head of household and single, then you are going to want to choose head of household. If you qualify for head of household and married filing separately, remember we can have that considered unmarried situation, then you would choose head of household. Married couples are usually better off with married filing jointly. So strictly from a tax liability standpoint, so how much tax do you owe, you're almost always going to be better off with married filing jointly, or at least not worse off. Again, you can run it both ways to make sure, but this is what you're going to find. However, there are some instances where couples might want to file married filing separately, regardless of the tax liability. So, for example, student loan repayment programs. There are some student loan programs where if the person works in a certain profession for certain employers, so for example, if they're a teacher working in a public school district, they would qualify for this. And what happens is if you work in that profession for a minimum number of years, then the government will actually forgive all or part of your student loan payments. How much they will forgive depends on how much money you make. So the less money you make, the more of those student loans will be forgiven. When they look at how much money you make, they look at your tax return. That's how they determine how much money you make. When they look at your tax return, if you are married filing jointly, they will look at your joint income, including your spouse's income. If you are married filing separately, they will generally look only at your separate income. So you can have a case, and it happens a lot actually, where they can save more money in student loan payments then they have to pay extra tax for married filing separately versus married filing jointly. So they may choose to file married filing separately in order to save the money on their student loan payments. Next, you could have one spouse who is taking very aggressive tax positions or committing outright tax fraud, and the other spouse knows it or suspects it, and they don't want to get involved. And so they say, I am going to file separately, even if it costs a little bit more money in tax. So that's their right. Remember, both spouses have to agree to file married filing jointly. Next, the spouses may be in the middle of a divorce, or they might just not trust each other. So they want to file separately. Or they just want to keep their finances separate for their own reasons. And that's perfectly fine. They have the right to do that. So you could run into any of these circumstances. There could be other circumstances as well. Just remember, strictly from a tax standpoint, married filing jointly is better, but there can be reasons to file married filing separately. Let's do a couple of examples. First example, Carol was divorced in 2024 and has two young children with David, her ex-husband. In 2025, the children lived with Carol for more than half the year, and she paid the costs of maintaining the home. Per the divorce agreement, though, David claimed the children as his dependents. Does Carol qualify for head of household filing status? Well, let's think about this. She has to be unmarried. Was she? Yes, she was divorced and she's not remarried. So she is unmarried. So she meets that. She has to pay more than half the cost of keeping up the home. She has to have a qualifying person in the house. Are the children qualifying people? Well, David claimed them as dependents. But remember on our chart, children are always qualifying people unless they are married and not dependents on your tax return. Well, she's got young children. They are not married, so they are qualifying children. So Carol does, in fact, meet all of the requirements for head of household, and so she can use the head of household filing status. Even though they are not her dependents on the tax return, they are still qualifying persons. Next example. Eduardo's wife, Maria, died in 2024. In 2025, Eduardo is still single and he is raising his two young children alone. He's paying all their expenses and claiming them as dependents. Since he's unmarried and providing a home for the children, a friend of his advised him to file as head of household. Should Eduardo follow his friend's advice? Well, let's think about this. Does Eduardo qualify for head of household? Well, he's not married. He provides the house for the children. They're clearly qualifying people. So, yes, he qualifies as head of household. So it seems like Eduardo's friend is on to something here. So, should Eduardo follow his advice? Well, let's think about it. Is there a filing status that might be better for Eduardo? And I'm sure you've already figured it out. Eduardo's wife died last year or the prior year, 2024. He's supporting the children. They are his dependents. He's paying the cost of maintaining the home. So we know that Eduardo qualifies as qualifying surviving spouse. So the answer is no. Eduardo should not follow his friend's advice. He needs to find a good enrolled agent to do his tax return to let him know that he actually qualifies for something better than head of household, and that is that qualifying surviving spouse. Now let's move on to dependents. We've already talked a lot about dependents and about whether the person is a dependent or is not a dependent. So, what does all of that mean? The term dependent means a qualifying child or a qualifying relative. It is that seemingly straightforward. You will want to know that for the exam. What is a qualifying dependent? It is a qualifying child or a qualifying relative. Now, it is not as simple as it sounds, because as we're going to find out, qualifying child doesn't necessarily have to be your child. A qualifying relative doesn't necessarily have to be related to you, but the actual definition itself is pretty simple. Now, it does not include housekeepers, maids, or servants who work for the taxpayer. So, what this means is that there was a time when people were trying to take their housekeepers, maids, and servants as dependents. So, the IRS had to come out and explicitly say those people do not qualify. So, let's look at this dependent chart. Again, this is from publication 17. So this is going to give us some rules at the top here. The first says that you cannot claim anyone as a dependent on your tax return if you can be claimed as a dependent by someone else. There is this one exception. If the person that's claiming you as a dependent, if the only reason they filed a return was to get a refund of amounts paid in other words, they weren't actually required to file a return. The only reason they did it is because they had some withholding from a job and they want to get that refund. Then you can still claim dependents. So, in other words, it's only if you're a dependent on someone's tax return who was required to file a tax return. Secondly, you cannot claim a married person who files a joint return as a dependent. Again, unless they weren't actually required to file that joint return. The only reason they did so was to get a refund. But the general rule is if the person files a joint tax return, you cannot claim them as a dependent. Next, you can only claim a person as a dependent if they are a U.S. citizen, a U.S. resident alien, a U.S. national, or a resident of Canada or Mexico. So any of those people you can claim as a dependent. Anyone else you cannot claim. And then finally, you can only claim a person as a dependent if they are your qualifying child or qualifying relative. Of course, we've already seen the definition of dependent is that they are a qualifying child or a qualifying relative. So, of course, if they are not one of those, then you cannot claim them as a dependent. Then we're going to see here that we've got two different tests. Test to be a qualifying child, test to be a qualifying relative. Remember, you have to be one or the other. So let's zoom in here to see it a little bit better. Test to be a qualifying child. The child must be your son, daughter, stepchild, foster child, brother, sister, half brother, half sister, stepbrother, stepsister, or a descendant of any of them. So, to be your qualifying child, they do not actually have to be your child. They could be your child, or they could be your brother or your sister, or your niece or your nephew, or your grandchild. Any of those can count as your child. So that's the first test. So they have to be in that category. Secondly, the child must be either under age 19, so age 18 or younger as of the end of the year, and they have to be younger than you. So if we're talking about your brother or your sister, they have to be your younger brother or sister. But the basic rule is they have to be under age 19 or under age 24 and a full-time student, or permanently and totally disabled regardless of what their age is. So the general rule to remember is under 19 or under 24 and a full-time student or permanently and totally disabled. Those are the rules. Next, the child must have lived with you for more than half the year. And again, we don't count temporary absences against them. And the child must not have provided more than half of their own support. They might have income, and that's fine, But as long as they did not actually provide more than half of their own support, they can still count as a qualifying child. And then the final rule is they must not be filing a joint return for the year, which we already talked about. So if they meet all of these tests, then they are a qualifying child and you can take them as a dependent. So now let's talk about qualifying relative. In order to be a qualifying relative, they cannot be your qualifying child or the qualifying child of anybody else. So, for instance, if they are the qualifying child of your ex spouse, then they cannot be your qualifying relative. Next is the person has to either be related to you in one of the ways on that special list that we talked about before, or they must have lived with you all year as a member of your household. So, in other words, a qualifying relative does not necessarily have to be related to you. It can be someone who's not related to you, but they lived with you all year as a member of your household as long as that relationship did not violate local law. So, for example, let's say you are in the midst of adopting a child. They are not yet your child. The adoption is not finalized. But if they lived with you all year as a member of your household, they would count as a qualifying relative, and you would be able to take them as a dependent. It could also be someone else. Maybe you've got a situation, a tragic situation where parents are no longer around, no longer able to care for their children, and a neighbor has taken the child or children into their house and they are taking care of them. Again, they're not related to that person, but they can still be considered a qualifying relative. Then the next test is that that person's gross income has to be less than $5,200. So if the person makes $5,200 or more in gross income, they cannot be a qualifying relative. And then the last test is that you must have provided more than half of that person's total support for the year. So if you meet that criteria, then that is a qualifying relative. So now, finally, the list, that special list of relatives who don't have to live with you that qualify for all of these various things. Get to see the list. Now, the list can look kind of busy and intimidating at first, but if you break it down into big chunks, it's really not that big a deal. So, first of all, you're going to start with your child or a descendant of any of them. So, it could be a grandchild. So, that's first. That's easy. Your child, grandchild. Next is a brother or sister in some form or another. Next is your parent or grandparent in some form or another. Next is a step parent. Next is a niece or nephew, aunt or uncle. And then in laws, son in law, daughter in law, father or mother in law, brother or sister in law. All of those count. And then any of these relationships that were established by marriage do not end by death or divorce. So once someone's your mother in law, they're always your mother in law, even if you end up getting divorced or if your spouse dies, for example. So again, think of this. Don't worry about memorizing every word here. Think of it in big categories: your child or grandchild, a sibling, a parent or grandparent, a niece or nephew, an aunt and uncle, and these in laws. That is who qualifies. It's close relatives. Next, let's talk about the support tests. Remember, for a qualifying relative, we said you had to have provided over half their support. So, what does that mean? Total support includes amounts spent to provide food, lodging, clothing, education, medical and dental care, recreation, transportation, and similar necessities. So, it's more than just what it takes to be providing a household. Remember, we talked about that, paying the cost of the home. This is actually supporting the dependent. So all of those things go into it. Lodging is based on fair rental value. So what would that person have to pay in order to get similar lodging? You can use that fair market value when you're deciding how much support you provide. And the relative's own income or funds count toward their support only if they actually use it for their support. So if they already have money in the bank, they've got $100,000 in the bank, but it just sits there and they don't use it for their own support, then you don't have to count that towards their own support. So let's look at some dependent examples here. George's wife, Marilyn, died in 2023. 2025, Marilyn's mother, Mabel, lived with George, and he provided virtually all of her financial support. Her only income was $5,000 in Social Security, which she donated to her church. Can George claim Mabel as a dependent? Well, let's think about it. Mabel was his mother in law, but his wife died. So is it really still his mother in law? Well, yes, we know that it is. Remember, those relationships do not end due to death or divorce. Okay, so we know that she's a qualifying person. She's not a qualifying child for anybody else, so we don't have to worry about that. She only earns $5,000, so she's under the income level, and George is providing more than half of her support. So the answer is that yes, even though his wife died, George's mother in law is still a qualifying person. He meets all of the other tests, and so he can, in fact, claim her as a dependent. Next example. Patrick and Irene have healthy twin sons who are living at home, John and Joe. They are 20 years old and single at the end of 2025. Patrick and Irene support both of them. John is a full-time college student, and he earns $15,000 at a part-time job. Joe is unemployed, not in school, and only earned $1,000 house sitting for some friends while they were on vacation. Well, Patrick and Irene might want to have a conversation with Joe about what he's going to do with his life, but it is what it is. So the question is, can Patrick and Irene claim John as a dependent? What about Joe? So let's talk about John first. John is 20 years old, so he is older than 18. However, he is a full-time student. So he's under 24 and he is a full-time student, so he is good there. He does earn $15,000 in a part-time job. However, we already said that Patrick and Irene are supporting him, so he's not supporting himself, so they are providing more than half of his support. So it seems pretty easy, and it is. We can see that, in fact, John is a qualifying child. Therefore, Patrick and Irene can claim him as a dependent. What about Joe, though? Well, Joe is not a full-time student. He's over the age of 18, so we know automatically he is not a qualifying child. We can end it right there. We don't even have to look at the other criteria. Not a qualifying child. So does that mean Patrick and Irene cannot claim him as a dependent? Well, we don't know yet because remember, there are two tests. The other test is qualifying relative. Is Joe a qualifying relative? Well, first of all, he cannot be a qualifying child. And we already established that he is not. Secondly, he has to be on that list, that special list. And is he? Well, yes. The very first thing on that list of relatives who qualify is the child of the taxpayer. So clearly he is on the list. Then he can't have more than $5,200 of income. He does not have that. And he cannot provide more than half of his own support. He does not do that. So therefore, we know that Joe does, in fact, count as a qualifying relative, even though he is not a qualifying child. So remember, you have both tests. Multiple support agreements. When two or more people provide for the support of a qualifying relative, you can have something called a multiple support agreement. So this is going to be most common when you've got adult children who are taking care of their elderly parents and claiming them as a dependent. So what can happen is those children can agree that any one of them who provides more than 10% of the support can claim that parent as a dependent. And a different person can claim them each year. They can rotate if they want to. So what happens is, let's say you've got 3 adult children and they're taking care of mom. And mom is their dependent. Mom might live in a nursing home and the kids are each sharing the support. What they can do is enter an agreement that says who is going to get to take mom as a dependent for the year. Because any individual can only be taken as a dependent on one person's tax return. You cannot have the same person be the dependent of more than one person. So what the kids can do is they can agree that, okay, one year, one of the kids takes mom as a dependent, the next year, another one, and next year, the third one, and go back the next year to the first one. They can rotate it, or they can just agree that it'll be one of the kids who takes her as a dependent, or two of the kids. Whatever they agree to is fine. The IRS will follow that, but the others have to sign this consent form, this Form 2120, saying that they understand that the other person is going to be taking the dependent. So that's what a multiple support agreement is. Divorced or separated parents. So oftentimes there are going to be disagreements between divorced or separated parents about who gets to claim the child as a dependent. So we have to have some way of deciding who that's going to be. Well, usually it is going to be the custodial parent that claims the child. So that is the parent that the child lived with for the greatest number of nights during the year. So we look at overnights. That's what counts. So that's the general rule. Custodial parent gets the dependent, unless there's an agreement. So the custodial parent can agree to let the non-custodial parent claim the child. Often this will be part of the divorce agreement. So they'll have a divorce agreement that says kids are going to live with one parent, but the other parent gets to take the kids as a dependent. Or it might say, let's say there's two kids, it might say mom gets one kid and dad gets the other kid. Or it might say mom gets both kids 1 year, dad gets both kids the next year, and that you rotate. So they can have some sort of agreement. And again, the IRS will honor that agreement. If you do that, you do have to fill out this form, this 8332, that explains what is happening, and the non-custodial parent then attaches that to the return. So what happens is the custodial parent, who normally would be entitled to the dependent, they have to sign this form saying, I understand that the non-custodial parent is going to take the child as a dependent. If you happen to have one from a pre-2009 divorce, which you're not going to have a lot of those anymore, although it could be, for instance, a disabled child. And you can, of course, keep taking a disabled child no matter what age they are. So if you have a pre-2009 divorce, you can just attach the pages from the divorce decree that explain the situation instead of an 8332. But if it's a divorce decree in 2009 or later, you have to have the 8332. What this does is it allows the non-custodial parent to get the child tax credit. There used to be something called a dependency exemption, where for every dependent you had, you got a certain deduction basically from your income, but we don't have that anymore. So the only real benefit for the non-custodial parent taking the child as a dependent is to get the child tax credit. The non-custodial parent does not get to use that dependent for purposes of claiming head of household, or for the dependent care credit or exclusion, or for the earned income credit. The custodial parent still gets those. Even though they don't technically take the child as a dependent, they still get those benefits. The non-custodial parent then only gets the child tax credit. What if you have a qualifying child of two or more people? So maybe you don't have an agreement in place that spells out who is getting to take the children as a dependent. Well, as we said before, only one person can claim a particular child or a particular person for the child tax credit, for head of household status, for the child independent care credit, for the exclusion of income for dependent care benefits, for purposes of the earned income credit. So we have to have a way to decide who gets to take this child as a dependent. So we have tiebreaker rules. The first tiebreaker rule is if only one person is the child's parent, then the parent wins. So maybe you've got a situation where you've got a child's parent on one side and the child's grandparent from the other side, and they're the ones trying to decide who gets the dependent. The child's parent is always going to win in that situation. Next, if both parents try to claim the child, then it goes to the one that the child lived with for most of the years. We talked about that before. We look at overnights. So whoever had the child the most overnights gets to claim the child. But what if you have a situation where the child lives with each parent equally? In that case, the parent with the higher adjusted gross income wins. So if the child lives with both parents equally, the parent who makes the most money is the one who is going to take the child as a dependent. If neither parent can treat the child as a qualifying child, then the person with the highest AGI wins. So maybe neither parent is in the picture anymore. Maybe they passed away. Maybe they're just not around. And maybe you got the grandparents on both sides who are both trying to take the child as a dependent. In that case, again, it's going to be the person with the highest adjusted gross income that will take the child as a dependent. There is this exception, though. If no parent claims the child, then, as we said, the person with the highest AGI wins, as long as their AGI is higher than any of the parents who can claim the child. So this sounds all convoluted. What are we talking about here? What the IRS is trying to do is to prevent people from playing games. So what you could have is a high income taxpayer who could claim their child as a dependent. However, it may be that the only benefit that that parent gets for having the child as a dependent is the child tax credit. And as you'll learn later, the child tax credit phases out and eventually goes to zero the more money that you make. So if you make quote unquote too much money, if there is such a thing, if you make too much money so that you get zero child tax credit, what a taxpayer might try to do is say, you know what? I'm not going to take the child as a dependent. I'm going to let my parents, the child's grandparents, take the child as a dependent. Then the grandparents take the child as a dependent. They get the $2,200 child tax credit, and maybe they just happen to give that $2,200 back to their son or daughter. And so what has happened here is that high income taxpayer has gotten around the child tax credit phase out and has gotten that money to their parents and beat the system, as you will. So what the IRS is saying, no, you cannot do that. If the parent could have taken the child and their adjusted gross income is higher than the person who did take the child, we are not going to allow that. That's what that rule is saying. And now let's move on to our final topic in this video, and that is the checkboxes at the top of the tax return. There are a few of them. There's one more this year than there was last year. So the first one is the presidential election campaign. So this says, check here if you or your spouse, if filing jointly, want $3 to go to this fund. Checking a box below will not change your tax or your refund. So there is this presidential election campaign fund that people who are running for president, it's like some public money that they can get to use for their presidential campaign. If people want to contribute to that, they can do so. And as it says, it doesn't increase the amount that you owe or decrease your refund. It's just saying, I want $3 of the taxes that I am paying to go to this particular fund if they check that box. In practice, most people don't check the box, but they can if they want to. Next box is for digital assets, and it says, at any time during 2025, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? So the IRS is still trying to figure out how to deal with all of these virtual currencies and NFTs and Bitcoin and all of that. So one of the things they want to do is to make sure that anybody who is dealing in those things, that they know about it, the IRS knows about it. So they make you say either yes or no. You have to check one or the other. Yes or no. Either you did do these things with these virtual currencies or you did not. And remember, everything on the tax return, you are doing under penalty of perjury. So when you ask the client, if they say, no, I didn't, that's fine. Again, they don't have to prove that they didn't. They said no, you have no reason to believe otherwise. You just check no and you move on, and that's fine. But if you happen to know the person and you know that they did do one of these things with digital currencies, then you need to check yes. And you need to explain to the taxpayer that they need to check yes because of the penalties of perjury, et cetera, and so forth. But in either case, you have to check the box either yes or no. And then the third box, and this is new in 2025, this was not there previously. Check here if your main home and your spouse's, if filing a joint return, was in the US for more than half of 2025. So there are certain credits, such as the earned income credit, that you can only get if you were in the United States for more than half the year. So the IRS wants you to declare, again, under penalty of perjury, right on the front of the tax return, whether or not your main home was in the US for more than half of 2025. And that is the end of video 1 for part 1. Only 19 more videos to go. And as with all of these videos, go back and watch part or all of it as many times as you need to and study the slides. And thank you for joining me on this journey. And I will see you in video 2.